Welcome to PhillipCapital Weekly Market Watch. My name is Victor Y. Today we are going through the gold price slump since the start of 2013, as well as the investment prospect for the yellow metal. Major indices are trading near their cyclical highs, while gold retreated to trade near its multi-month low. Gold peaked on the announcement of QE3 last September. Equities, however, did not share the optimism, as there was a fiscal cliff looming at the end of the year. With the 11th hour deal struck in the Congress, risk-on appetite crept in, and gold, as a safe haven, lost its appeal to investors. Political posturing between the Democrats and Republicans as they negotiate the debt ceiling may bring gold back in favor. There are several factors exerting downward pressures on the commodity. For one, demand from major importers of gold is muted. Import duty hike in India, for the second time in less than a year, has dampened the demand for gold. The hike from 4% to 6% in January was an attempt by the government to rein in on its current account deficit in the 2013-14 budget. Combined with general depreciation of Indian rupee, purchasing power of Indian consumers for gold has eroded significantly. Big price action could also be attributed to China having its week-long holiday. Gold has been thought of as a hedge to rising consumer prices. Despite major central banks' initiative to expand their balance sheets, inflation as measured by CPI has not picked up significantly to warrant the purchase of gold. As can be seen in Chart 2, inflation did not threaten to spike. Correspondingly, gold price trended downwards. The yellow metal struck a record high at around 1920 per ounce in summer 2011 when a worsening debt crisis in Europe sparked a buying rush. Gold, denominated in US dollar, tend to have an inverse relationship with the strength of US dollar. Weaker US dollar boosts demand for the precious metal as it becomes cheaper to purchase. As can be seen in Chart 3, the downward trajectory of gold corresponds with the upward movement of dollar index. The inverse relationship becomes obvious if we look at the past 1 month chart on the right hand side. While the dollar index gained 1%, spot gold slumped nearly 5%. The recently concluded G20 meeting led to a sell-off in gold as finance ministers vowed to not engage in competitive devaluation of the currency. In essence, no devaluation of US dollar, gold price will likely remain soft. On an interesting note, billionaire investor George Soros amassed more than 130 million of gold in second quarter, before shaving about 40 million of his gold holdings in fourth quarter, according to SEC Form 13 filing. His portfolio is very much watched by many investors who follow the smart money. Hence, to some extent, the rippling effect of his declaration dampened the gold sentiment. In the coming days, the US would release its inflation data for the month of January. Upside surprises for gold would come should inflation tick higher than estimated. In addition, equity rallies may pause on US budget sequestration in the near term. Besides, central bankers and opportunistic contrarians may take advantage of the weakened gold price as the commodity may once again dip below the psychological barrier of 1600 per ounce. Phillip Research is underweight on gold. Phillip Unit Trust advocates a diversified portfolio. Thank you for watching our weekly market watch. Stay tuned for more updates.